1, 2, 3, 4, 5, 6. This pattern has happened a number of times so far this year. 1, 2, 3, 4, 5, 6 times. Are you ready for it? If not, here is what I suggest doing. Make a plan. Pause if you need to. This is our goal. Also, if you're not sure where to start, this is also what I would suggest doing. This is my personal plan. Click on the link if you want to see that. Should be third from the top. Avoid what you're going to regret more. If you do or don't own stocks, again, normally I just do this one right here. Stay tuned and I will walk you through exactly what that means for this week because, yes, the market can remain irrational longer than you can remain solvent. So what that really means is that we want to understand what the market is doing because our goal as investors is to be competent. Over time, we see here that time and experience gives us competency. We want knowledge to become experience. We don't want confidence or con men, right? Those guys are kind of stupid. No, we want to be sustainable. Why? Well, because I don't know how much the market's going to be overbought for or for how long, but I have a little bit of a plan and I can walk you through some math and some formulas a little bit later in today's show. Simply put, I do not need to be confident. I want to be competent. Why? Because over time, I just want my account to go up sustainably. I don't need the big up and downs. And really what this comes down to is the emotional cycle versus the technical chart cycle. Are people feeling a little bit euphoric? That's right. We're geniuses. We're all going to be rich. And I defer to people who were smarter than me in times like this. Like who? Like literally a market wizard, Mark Minervini. The rules I built my 45-year career on in a personal fortune. I always use a stop loss. I always have a predefined plan to admit I'm wrong. That's number one. Define your stop loss before you enter a trade. Make sure you know where you're wrong before you buy. Never risk more than you expect to gain. Make sure your risk reward is greater than 1 for 1. Nail down decent profits. Trim. Never let a good sized gain turn into a loss. And never let a green trade go red. Never average down. Why? It's not working. Average up. Never let bold when running cold, right? When you're on a cold streak, don't take big shots. And even more. Okay, avoid style drift. Well, that's me. I'm trying not to do anything differently than I do right now. Why? I'm listening to people better than me. So this pattern that I'm pointing to here is called a failed breakout. It's called a failed BO, failed breakout. The challenge is that it's only visible in hindsight. There's your high, there's your all-time high, but it's fail, right? False break, fail break. That's what they call it. Back here we have 1, 2, 3, 10% correction. All right. So if we go back in time, we had it 5 times before the big one. The big one was a bear market. This period right here is a bear market. So 1, 2, 3, 4, 5. Okay. So we can do 6 before. Sorry, we did 5 before. Yep. The previous cycle before that, we did 3. So you can see that's a bear market. That's a correction. That's a bear market. So as we go through here, we can see that the current cycle has had it happened 6 times. 1, 2, 3, 4, 5, 6. That's why if you've been seeing people flip and flop or the charts are going up, they fail. They go down, they fail. Here, we're only talking about failed breakouts, not even failed breakdowns. And now we can see the exact percent declines to try to understand exactly why this pattern is happening so repeatedly. 27% decline, 11% decline, 21% decline. That's a pretty big cut, 27%. Yep. And then here's the gains, 31, 49, 38. So after a 21% decline, the velocity going higher led to a 38% rally so far. Well, that's pretty good. What I'm asking myself is, where is the law of diminishing returns going to kick in? And I say that because as I look here, productive returns, diminishing returns, negative returns. Oh, is that what happened in previous cycles? Is that what this pattern is right here? Yeah, it's a top pink signal. I can't tell you exactly when the top happened. We literally only know that in hindsight. But I made a video called Mega Crash right here at the all-time high. And people didn't want to believe it then. Just like they don't want to believe it now. Why? Going up feels good. It feels really good. Let's read what the law of diminishing returns says from the AI overview from Google. All right, what do you tell us, Mr. Google? Well, it says the law of diminishing returns is an economic principle stating that the more you add more into it or a unit like labor to a production process while keeping other inputs fixed, the additional output gained for each unit becomes marginal, eventually becomes smaller before it becomes negative. Kind of like our dollars here. Yes, which is why I remain 100% cash in this account. Why? Crushed it. My goal for the year is done. I'm currently taking a rain check. I'm waiting for these alerts. And if they don't come through, this is exactly what I'm going to do. I'm looking for A+ setups only. Otherwise, this cycle will play out. And I'll describe exactly what I see as this cycle right now. What this really comes down to is Newton's first law. Again, someone smarter than me. And what he told us is that an object at rest will stay at rest until there's an unbalanced force. And that's basically stocks going up. When they start going up, they cannot go down until they are acted upon by an equal and offsetting force. So what this really means is that when stocks start going higher, they're going to keep going higher until they start going down. Kind of like I showed you over here. Again, the law of diminishing return says that after we've rallied so much, normally there's a decline around the corner, right? A dip is 5%, a correction is 10, a bear market's 20. So a correction or a bear market will happen at some point. They happen consistently, normally one per year. So how do I get that equal and offsetting force? Because right now stocks are very irrational and some people are not solvent anymore. Yep. Well, it's literally impossible for us to go down by 20% or 10% unless we go down a little bit first. Again, literally this right here. If we're going up, we got to stop going up before we can start going down. That's this right here. We got to print a lower low. We're cautious. Then we get cautiously bearish. Then we're bearishly cautious. Then we're bearish. Well, for monthly candles, that's going to take months. For weekly candles, it can happen faster. And that is where our gateway for the bears is now going to be at the weekly low. The weekly low this week is going to be the L at 654.29. I already set an alert for that. So there's nothing we need to do. I will update you if anything changes. All right, now, I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up or subscribing to the channel, I would greatly, greatly appreciate that too. I put a lot more effort. I'm pausing the video more today because I do want to present things in an easy to digest fashion too. I'm going to come back to this in a moment. It's one of the most important ways that I look at charts. So today's going to really be a lesson on how Justin is doing a postmortem on his personal trading. That's basically it for today's show in terms of what's really important. The failed breakout pattern is not going to give us a crystal ball. It just tells us that we're red lining, right? We're red lining right now. False breaks do happen. We're seeing these on some key charts. I'm not going to go through those today because honestly, I just got so many of them. Here we go. I got all these charts here, but here's one. Here's the IWM or the Russell going to a new all-time high, but it fell back below it. It's not by a lot. We can see that it's a monthly candle. We poked over. We're now back below. Poked above the previous all-time high. What happened last time? Crash. I'm not saying that's what has to happen. It's just a notable chart for me. Same thing here with the dollar. If I look to the dollar for this year, I'm looking at an annual chart or the DXY or Dixie, US dollar index on a 12-month chart. What I note here is that it's a bearish engulfing annual chart, annual candle. Well, it does happen before right there. Right there. Oh my God, that's 2000. Yeah, that's 2000. What's this one here? Well, that's a bearish engulfing candle too. That one's not so pretty. No, it's not. 1, 2, 3 red years. 1, 2, 3. Well, that's the first red year. QQQ. Man, this chart is red lining. Woo, right. I'm impressed. Yes, the market is irrational. Then longer than I can remain solvent. I'm not betting against this. To be clear, our system waits for early evidence until we actually start going down. Gold, oh my goodness, rocketing. Volatility at 15. No one needs insurance. Maybe a great time to buy one. Here's what's really curious too. The US 10-year note on a weekly perspective actually closed higher. This W part that I'm highlighting here, well, it's not going down, right? Stuck between the 50 and 200. It's a box. It's boxed in, and it's actually higher on the week. We cut yields by the equivalent of 100 basis points this week. Again, forward looking, but the 10-year note is actually higher, up by 1.6. Bitcoin's on a stairway to heaven, taking every step going up. We have to see where it's ultimately going to exhaust itself. Why? Well, there's that pesky failed breakout pattern because every time recently the Bitcoin's failed, there's a failed break, high, lower, low, lower, low, lower, low. Fail break leads to a bearish engulfing candle. Fail break leads to a correction. Fail break, is there a fail break here? There's one right there. Fail break goes to the low. Fail break number 1, fail break number 2. If we fail to make a higher high here, I think the Bitcoin's going to go down. Ethereum here is right at all-time highs too. Again, new all-time high, but currently falling back below it, which means a fail. It's already been 3-4 candles since then. Silver looks really strong. Oil is failing. So just because we have a bullish setup here, like a giant cup and handle, it doesn't mean it has to pass. Oil right here actually has a cup and handle, and then it failed. It failed. Copper, same thing here. We have a topping pattern potentially. We have a rising triangle or rising wedge, rising lows with a flat top. All right, there you go. There's a couple of key charts. And then SMH actually turning into a stud here. Look at that previous resistance acting as support here. Nice, nice, nice. We'll go through more charts this week. Here is the S&P going into this week. There's those candles that I pointed to before. There's the previous times it happened. 3. So 20% correction, 3, 10% down. After 10% down, 5, and then 20% down. Well, now we've had 6. 6 failed breakouts. So we're technically in fully bully boomtown buy all dips because we're bullish on the weekly chart, the 1 day, the 1 week, the 1 month, the 3 month, and every chart. Yellow boxes basically just mean fail breakout, or see the thread above I just talked about. We also mentioned this, that technically it is impossible for us to start going down a lot until we at least go down a little bit. We're not going to get a bear correction all the way down to number 2, which is my strong support, until we go down a little bit. That's losing number 1 or the uptrend. Right now we're trying to get a topping signal, but look a little bit silly this week, don't we? Yeah, that's okay. We're just being risk managers. And if people don't appreciate that, that's totally fine. Why? They're not going to watch after 10 minutes. This is where the good stuff comes in. All right. We have been getting warning signs for a very long time now. Some may not believe it, and when and if it finally happens. The SH algo has now missed its window, so we're not likely going to get that anymore. We're going to have to rely on our dots. What do our dots tell us? It's in fully bully boomtown buy all dips. The gateway for the bears is 654, which could potentially open a move back down to 613. Again, we can't go down a lot. We're down to 613 till we go down a little bit. The daily chart did break. It got fixed. Higher lows are sufficient after adjusting for the dividend. If you look at SPX, you'll see that. 4 out of 4 on the weekly, monthly, and annual, quarterly. Everything's fully bully boomtown. So I've set the alert, as I mentioned before. There's nothing for us to do. We want to be mindful of days this week because on Friday, we're actually expecting core PCE to come in at 0.2 when it was previously 0.3. Is that going to give the bulls even more juice to rally the charts higher? Hey, let's look and see. If we look to key dates for this week, that's what I just showed you here. So GDP comes in on Thursday, and then we got core PCE on Friday. There is going to be earnings from Costco this week. I don't think it really matters. Here's what matters more for me. It's the fear and greed. So we did form a higher high relative to 57. What happened? We went up even more. Now we're at 62. That's what I'm trying to show you right here. From neutral a week ago, back up into greed. We'd have to fall back into neutral, back into fear for this to actually be bearish momentum. Again, backwards looking way to look at it. We're now over a year, so this is now actually gone, but that was the head and shoulders, which led to knees and toes. We mentioned this was a multi-month leading indicator. It's not going to happen immediately. What do we note here? Well, we have a downtrend, so it's nice we formed a higher high versus here, but there's always bounces along the way, right? Bounce, bounce, bounce. We got to form the higher high, which means what? We got to make it above here. Let's see what that exact number is because I think that'll be important here. Let's actually check it. Let's check it together. We have to get above 67. Why? Because that would be a higher high. Over 67, the exact same thing as here could happen. Above 56, I said, well, it could squeeze. Why? Well, people are offside. We can see that this week because the shorts are piling in. They're 225,000 contract short. That's a pretty big increase. Why? Going below 200,000 has only really happened going back to 2022, 2023. And that's basically the bottom, right? They're capitulating. Oh my gosh, shorted more. How can the market be going up? Well, contracts rolled over, right? That's ES actually expiring and getting rollover. Is this going to happen? All right. So just before we go into here, again, I'm going to highly suggest you pause right now if you need to, or go to the link. It should say free notes, second or third one in the description, and you're going to land right here. It's the top 2 most important best practices for an investor. What do? Make a plan and then respect the plan. Make a plan and then respect the plan. That's it. Yeah. Make sure you know how charts go up or down. That's all they do. All right, cool. We got that out of the way. Here's where I usually fall into. I've been trimming and I continue to trim. How much? 50% for me personally, because I'm trying to be consistent. I don't need to be in there gunslinging every day. So what do? I generally fall into here because I'm a wussy, and I generally do this one right here. If you don't know where to start, you've probably got too much going on. So again, think about it now. If the market really does turn, do I know exactly where I need to look in my account? On the same token, if the market keeps going up, am I going to regret that? Of course I do. I regret it. I regret when it goes down more, though. All right, let's think about an ATR, or an average true range, because what this really shows us is the velocity of whether a stock is going up a lot or too much. So again, let's read the indicator here. A technical analysis indicator that measures market volatility by decomposing the entire range into an asset price for that period. You can see here on TradingView how to do that. You go to indicators, type in ATR, and then average true range. Top indicator there. What is it going to show you? A little line at the bottom right here. This basically shows you the average range of each candle, or the average true range over time. So as the chart goes up or the candles get big, right, the ATR jumps. It jumps. Why? Candles are getting bigger. That's the average true range. As the average true range starts to get tight or the range gets smaller, you can see it flatlines here. We have a big contraction or candles get big, well, then the ATR jumps. So it basically is a volatility way for us to measure that. We also know on a distribution of outcomes where this should actually happen. So this is called our bell curve of adoption. It's also just a standard deviation. So if it looks familiar, it's not an accident. The standard deviation is a commonly used in determining of what constitutes an outlier and what does not. AKA, is this a boom headshot time to go long, or is it so good we can't say no, or passing on a trade? Well, right now it's easy for me to pass. I'll show you why mathematically. We've added the ATR to our chart. Now we got this set up right here. What does it show us? It shows us the ATR is 34. Let's highlight that right here. Where's support? Well, support would arguably be on the blue line, because after a big move up, or again, a deviation from the blue line, what happens? Right back down to the 50, close to the 50, close to the 50. Didn't quite hit it. So hit the 50. When we go too far up, ATR jacks up, hit the 50 MA, hit the 50 MA, hit the 50 MA. Sorry, close. If we do hit it, we can actually know how many months that would take or what that would look like. Why? Hover over. Shows right here. It's 34 ATR, 34.4 ATR. So for this current candle, the ATR is 34.4. Now we can see what this means. 657 is the current price. I did this last week. 486 is the 50 MA. Now we get the difference of that of 171. So what would be the average true range for a monthly candle for SPY to go from where we are to where support is? Because remember, just because we hit the 50 MA doesn't mean we have to hit it. We can also go below the 50 MA. But how many candles on average would it take to go from where we are to where we could go at support? Well, that's 5 standard deviations. So on a bell curve of distributions, it just means that like it's an outlier right now. Like the market's irrational. How much longer? I don't know. It's due to cool off this week, next month. I don't know that part. I have no idea. So here's what I'm talking about. It's called mean reversion. Mean reversion just basically means that it's a theory that an asset price eventually reverts to the mean, the long-term average. What's that? A moving average. That's my blue line. That's a moving average. That's the mean reversion. Look at SPY in a monthly chart. Oh, it does actually usually hit the 50 MA. Yep. And we talked about this 3-cut recipe. So we got unos, dos, tres. Is a trace one going to come in? Aren't there trois? And remember, if we go here to a log scale, again, I'm not trying to scare you. What I'm trying to do is to frame a range of outcomes for you. What could actually happen? Well, it is possible we could go below the 50 MA when we overshoot it for too long. Sometimes where we expect to find support, there's not actually support. We get too far from the 50 MA, again, deviate too far from it. What happens? Crash on the 50, but it goes way below the 50. I'm going to show you that in a minute here. Why? It's very curious how this actually works. So mean reversion basically means that we come back to our average over time. Over the 50 MA, then I'm going to go all the way back just here to the, we're just going to look at the weekly chart for the S&P. Why? I just want to show you that what I am personally waiting for now is my boom headshot trade. What does that mean? It has to be so good, I can't say no. I'm a sniper. I got maybe 2 or 3 bullets. I am not wasting a single one. And like I said, just because the market goes over the 50 MA and hits it, well, look right here. Let's go back in time before we look at the next example, because that's what's going to solidify it. Just because we get too far from the 50 MA does not mean we have to go up. Here's your distribution part, right? We're going sideways. What happens? Hit the 50 MA. We find buyers, but it's a dead cat bounce. What happens? It goes lower and then lower. So we do actually deviate further than the 50 MA. We draw a horizontal line like this. We spend too much time over the blue line. It comes back down below the blue line. Goes over the blue line for too much. Comes back below the blue line. How much it overshoots above the blue line is called a measured move versus the move lower here. And what I'm going to show you now is basically, again, trying to show what all these things together is for the average simple person. So if normally we hit the blue line, we've got through that now, right? Going back to a weekly chart for the S&P now, Vanguard S&P 500, I'm looking at VOO. So I have all my lines on my chart here. I can jump back to it on any stream. Another reason why maybe you want to subscribe is because I have them all right here. I will update you on it. I'm going to show you exactly what that means now. It looks a little bit confusing. All right, so back to 2018 and 2019, what do we have? Well, the push over the 50 MA is an equal size box as below. So here's what I did. I'll show you the first example here. We'll go back to 2019, just so you understand what I did. And this video is a little bit longer, so again, please consider smashing that thumbs up or subscribing to the channel because I'm putting in extra effort here just for you. I don't need to do this again. It's already in my notes, but I'm doing this because I think you'll benefit from it. All right, there's our first box. Let's copy it. Let's go paste. Control C, Control V. We're going to put it below. Now what we can see is that the move above the blue line, which is the bottom of the box, up to the top of the box, is basically our high. Then we copy that and put it down to the low and the high, which means after we lost the blue line, that's how far we push down. So if we go up by too much, we go down by more. That's what I just showed you with those waves. All right, we got that out of the way now. So 2018, measured move is the same. Spend too much time above, we go exactly by that amount below. Okay, that happened here. But this time it's actually more than one measured move. It's almost two. Why? That's how much time above. There's the same box below, but we overshot. It's actually pretty close to 2 times bear. You can see the wick right there is like really close. So it's nearly 2 times the move below. Whoa, 2 times below. Don't tell me that. Nope. Here it's more, roughly equal, but it's more going sideways. Again, more distribution and accumulation than anything else. This one's a little bit trickier because it's not a V. So again, roughly equal time above, where the high is right here, to roughly equal time below. A little bit more tricky though. This one here is 1.5 times. So this goes back here to 2024 and 2025, where one box is equal to this measured move right here. And then I would argue, like, I don't know, like roughly half the box here. So whenever we were above the blue line buy, we overshot by 1.5 to the downside. I showed you the ATR example. This one's called a measured move. All right, now let's look at the last one. Uh-oh. Now you're bringing it all together here. Yeah, I'm trying to. Nice and simple. The amount of time we spent below here, or how much we overshot by standard deviation, copy that box, put it up here. Well, let's think about this. 625 is the equivalent of liquidation day, when we basically said the whole world is taxed, you're effing fired, and we're not going to do business with anyone. That was peak fear. Well, we're pretty close to 625, right? In what percentile we are, we're getting increasingly closer to that negative law of diminishing returns, where at some point it's going to be negative. Where? I don't know. I'm already getting a little bit antsy here. So, and oh my God, I can't believe the timing on this, right? The White House tweeted and said this, X the White House. Oh my God, right? Don't be a panickin. I wasn't going to show this, but man, I can't not talk about it now. Do not be a panickin, you wussies. Yeah, don't be like Justin. Don't be a wussy. I have some memes and stuff too, but I'm trying to be a little bit more serious in here. Where is it, right? Don't be a panickin. Oh, not panic all, panickin. Yeah, don't be a panickin, right? Don't be a panickin, right? Rally some new highs. Here we go. Yeah, stock market. The CEO of SPY. Oh my goodness, the CEO of SPY. He's quite the guy. All right. Anyways, going back to our monthly chart. So now, if we think about this, for us to go back down to our 1 month support, or again, our standard deviation. Now we've gone through. It's not me telling you this. It's just me looking at the data or the math. Now, in terms of us going back from our monthly chart back down to here, 5 standard deviations basically means this. Let's keep it really simple. Keep it simple, stupid, right? I'm a simple guy. Maybe you are too. On a monthly chart, it would take 5 candles is what it would require to hit on the down of the total range in a row before we hit support. That's not before we overshoot to the downside. So if we're showing you standard deviations or measured moves, and it took an equal move lower to have an equal move higher, and let's think about this. 5 months is how much we've overshot for. If it's 5 to come back down and we have a measured move to the downside, that could be 5 plus 5. That's 10 months. In 2022, it took almost 2 years for you to get your money back. People didn't want to hear it then. They probably don't want to hear it now. This part right here was very difficult for people. Why? Well, if you look right here, we went from 480 down to support, but from roughly December of 2021 all the way till February of 2024, you made no money. You got your money back. I don't like getting my money back. I like making money. So when I see potential for a crash, I pay close attention. I am not joking around. And because we're squeezing on the monthly candle here, we're probably going to close at or near the high of the candle. Is that when we get our failed break? I don't know. We got one there. We got one here. I'm not sure, right? I don't know everything, believe it or not. Here's what I do know. It is impossible for us to go down a lot until we go down a little bit. So right now, after a trend change, higher lows are sufficient. I just showed you that. So again, at the beginning, I also said that we can only go lower by a lot if we go down by a little bit. This needs to happen. I don't know when it will. I think we're due for it. I think we're way overdue. I'm showing you mathematical reasons why. I'm showing you emotional reasons why, sentiment, positioning, but I don't know for sure. The only thing that's for sure is that nothing is for sure. So again, Dr. Wussy or Justin is here. I prefer to sell into strength than weakness. So we're redlining. And I think that's a great thing to sell into, right? There's liquidity right now. Take it. With my goals versus my returns, I'm strong number one. I'm Dr. Wussy. I'm scared when stonks go down, right? Those I call those stinks or not stonks. I don't like that. I like stonks. So here's a stock market cycle, peak to trough on a nice little crash or a wave. It can ebb, it can flow. Here's a technical chart. Here's the emotional feels you get. So here's what a stock market cycle actually is. There's 4 stages to it. Number 1, number 2, number 3, number 4. Accumulation, markup, distribution, markdown. That's all that it does. Up and down, contraction, expansion. It's all it does over and over. If you look out into the ocean, you see big dark clouds, you're probably going to get big waves. So what do I see? Man, I see the storm clouds forming. There's no waves right now, but I think up in the sky, we're seeing exactly what scares me. It's this right here. Be like water, like Bruce Lee tells us. Why? This part right here. I see is potentially peaking. Where? On a weekly chart, on a monthly chart. We're going to crash line on support, and then to be determined. I don't know what's going to happen. Be like water, ebb, flow. Right? Just go with the price action. If you can click on this link too, that'll give you more context here. All right. So what can you do? Well, what I would really suggest is that you just subscribe to the channel, really. And then finally, the reason I say that is because I do plan to give more stuff for free. Our freemium model means that I really do want to warn you. I want to tell you what I'm doing in my real account. Use this more like a vlog. I'm concerned about this. When will it happen? I don't know. Over time, if you want to follow for free, I will do that happily on YouTube. Please subscribe. If you go to the link in the description or to theelgo.com, you can also join a waitlist to see what it's like to follow me and to follow my journey over time. There's a waitlist. I encourage you to click on it if you're interested. Otherwise, I will see you for the next video on Monday. Thanks so much.